Q1, first quarter of this year, has been a very challenging backdrop, a challenging environment from a market and macro standpoint. A quarter of two halves, I would say, between the start of the year and the end of Q1. But despite that, we have a strong set of results, a resilient set of results, and that's demonstrated in an adjusted profit of almost 280 million, which is the second highest actually that we've had on record, and really underpinned by a strong revenue base, strong management fees that have increased by 9% year on year, and profits have increased by 12% year on year. So why is that? If I come to your question specifically on clients, of course in this environment there has been a shift in asset allocation. Clients are de-risking and repositioning, and we've seen that in our net flow results. So net flows excluding cash, positive 5.7 billion of net inflows, and they're going into those higher margin active and alternative asset classes, as well as repositioning specific institutional mandates as well, and out of, in our case in Q1, out of cash and out of fixed income on a net basis.
What are you telling your clients? How can they actually safeguard their asset against the high inflation numbers we are seeing?
So in this environment, exactly that, we're seeing higher inflation, persistent inflation, price rises, and of course interest rates continue to go upwards. And so that repositioning from clients is looking carefully at cash. How do our clients need to repurpose their cash? Look at different liquidity options and solutions. So cash has gone out in the first quarter. Similarly in fixed income, a different portfolio mix that we're seeing there. A shift to shorter duration from longer duration. We've seen some of our insurance clients repositioning on the fixed income side. But alternatively, if we look at our alternatives asset class, we've seen net inflows of 1 billion going into liquid real assets, into real estate, into infrastructure. We had a technical outflow in alternatives, so actually the real performance is much stronger in terms of true net asset allocations from clients. And I think that's something that we expect to see on the real asset front in the outlook. Similarly, in active, multi-asset solutions, of course, are in favour. We've seen a very strong inflow in that asset class across both retail and institutional clients. And active equity, despite the volatility that we have seen in the first quarter in the equity markets, we've seen an increasing allocation to our active equity funds. So definitely a shift of direction across the portfolio, but it's a good, healthy mix that really holds up the revenue base in the first quarter and should put us in good stead for this type of environment.
Let's talk about Russia as well. Are you having staff on the ground there, and how are you dealing with it, and what are you doing with the money invested in the Russian equity markets?
Yes, so we don't have any staff in Russia. We don't have any staff directly in Ukraine. We have a very small, negligible exposure to Russian securities. Where we have had, or we do have specific funds with an exposure, we have suspended, obviously, redemptions and subscriptions to those funds, and we're managing those in line with the regulatory guidelines. And we have taken the decision in our active mutual funds, of course, not to invest further into Russian securities in this environment. So I would say a low exposure that we carry there, but we're very vigilant in the risk management. And of course, equally or more important, on the humanitarian side, we're very focused on how we can contribute as a corporation in terms of donations and volunteering.